Bobby, thank you very much for joining me. Over the past few weeks, we've seen a lot of fluctuations in the markets. How important is it that you're able to monitor those across a week, a month, a year?
In a period when pensions are becoming more and more expensive, we've just gone through a valuation with one of my clients, and most companies are being asked to pay more money into their pension scheme. This client didn't have to pay any more additional money into their pension scheme. The reason was that in the previous 2 years, they'd taken out half of the risk of their investment strategy. And they've been able to do that because they'd been monitoring markets on a daily basis, and 2 opportunities arose, which, because they had a plan in place and because they'd agreed with us to monitor the markets on a daily basis, we switched assets over a 24-hour period. And that took half of their equities into bonds.
So what you're saying is it's not about monitoring on a weekly or a monthly or a yearly, but it's about doing it every day.
It's about doing it on a daily basis because markets move very fast. You just have to look back at this year. In February looked like the first quarter of the year looked quite a dull month for markets. Equities went up by 0.1, 0.2%. But from the start of January to the middle of February, they went down by around 10%, and then they bounced back around 10% in the next half of the quarter. Equity markets don't stay stable, they move around very significantly.
How do you put a scheme in place, though, that allows you to do that? It must be horrendously expensive for most of the kind of small to medium-sized schemes that you're dealing with.
Well, we set up a service specifically for smaller, medium-sized schemes a number of years ago, which allows them to have the comfort that they can monitor markets on a daily basis and be able to act when opportunities arise. So we give them the comfort by having a pre-agreed plan, which we agree with them, and then when a market opportunity arises, the investment consultant does a check to make sure that it's not going to trigger extra contributions, and the actuary also does a check to make sure that if he did a new valuation on that specific day, the client would not have to pay any more contributions in when they move these assets from equities to bonds.
At its best, then, it is saving employers a lot of money.
In this particular example for this client, they went from a position whereby equities had moved by 10% down. They would open up a funding gap of 2 million. After they made the switches, if equities had moved by 10% down, they would have a funding gap of 1 million. So it significantly reduced the risk. And this is in the context of a scheme which is only 20 million in total size. So those amounts of movements are very significant to the pension scheme, and more significant as well to the employer, who is a pottery company up in the north of England.
How many then of the small and medium-sized businesses in the country with small schemes or medium-sized schemes have something like this?
So most small schemes don't do this because they think they have to delegate their assets to another party and lose control of their assets. The service that we've set up means the trustees can keep control, and the reason they can keep control is because we give them the comfort that experts are going to check before a switch is actually made that the switch is still applicable. And so all small schemes could do this. The service we have is affordable for small schemes, and the risk reduction it provides is significant enough for schemes to want to pay for that.
Bobby, thank you very much indeed.
Thank you.